Dear students, welcome to video 2 in a series of videos which is taking you down through the material for sources of finance. In the previous video we looked at the general terms and the sources of finance that are available internally within an organisation. Without further ado, we will now look at the external source of finance available to the organisation, commencing with the short term. Just as a recap, remember short-term sources of finance are repayable in a period less than 1 year, medium-term sources of finance between 1 and 5 years, and long-term sources of finance repayable over a period greater than 5 years. So let's take a look at the short-term sources of finance available. These typically include a bank overdraft, a term loan, debt factoring, and invoice discounting. Let's now take a look at each of these in turn. In respect of the bank overdraft, this is a short-term source of finance, and a bank overdraft typically allows a business to operate in a negative balance on its bank account. So think of it as the organisation is basically going into a red. They've overdrawn on the account, so overdrawn more than the money available. It's a very popular and very flexible source of finance that a lot of organisations and businesses avail of. It is subject to bank approval, however. It's easy and cheap to arrange. The bank may, however, request forecasts of cash flows, so i.e. budgets, maybe for a 12-month period. Variable interest rates depend on the creditworthiness of the customer. However, it is repayable on demand, so i.e. the banking institution can say, I want my money back tomorrow, and the organisation must transfer the funds. It is subject to periodical review from the banking institution, and security may be required. The security might be that the organisation must pledge, for example, an asset against the loan. And it can continue for years over the long term rather than a short-term source of finance. Next, we have the term loan. The term loan can be used as a short or medium-term source of finance. I always recommend students to learn the term loan one from the perspective of the long questions in the exam, particularly where you might be faced with a scenario and asked for suitable sources of finance. A term loan will typically cover off any kind of scenario you're going to be presented with on the day of the exam. A term loan is usually granted for a specific reason, so i.e. it could be the purchase of a particular piece of equipment. You may be able to negotiate terms and repayment schedules. Interest may be fixed or variable. So fixed is where the interest rate that's going to be repayable on the loan is agreed between both parties prior to the drawdown of the loan. Variable is where the interest rate coincides with the interest rates in the marketplace. As it stands, the fixed rates are more favourable in the economy at the moment in comparison to the variable rates that seem to be rising quite frequently. Interest is repayable on the outstanding balance. An arrangement fee may be payable to the financial institution, and security or a guarantee may be required. Borrowers categorised in respect of AAA, AA, A, all the way down to D. AAA is the highest credit rating associated with the financial institution. Loans may have obligations, so for example, information obligations, whereby the management might have to present a set of financial statements to the bank over a period of time in order to demonstrate the financial performance of the organisation. The next source of finance available is debt factoring. We actually looked at debt factoring in topic 2 when we looked at our accounts receivable. This is where a finance company takes over the sales ledger administration, and it may offer insurance against bad debts, and it may carry out credit checks on our customers. i.e. a debt factoring company typically goes out and collects the monies from our customers. The fee is based on turnover, which is approximately between 2 and 3%. It can be quite costly as a result. The factor may give cash advances of 80 to 85% on trade debtors, but again it does charge interest on advances. The remainder paid when the debt is then collected. The interest rate is charged, but it may be higher than the overdraft rate. It may be useful for small companies releasing staff to other duties. So for example, if you have an individual within the finance department responsible for ringing customers up looking for the repayment of monies, If you actually availed of a debt factoring company, it would release this particular individual to concentrate on other areas of the business. It may be with recourse or without recourse, so i.e. no risk. However, issuing or availing of debt factoring may give a negative impression of the company, and as a result of that, you may lose customers. Next, we have invoice discounting. This is very similar to factoring. It relates to specific invoices rather than the whole sales ledger. So in the previous case with the debt factoring, that particular factoring company takes over the entire debtor's ledger. However, for invoice discounting, this is not the case. They only take over specific invoices and not the entire listing. The company may obtain an advance of 75% to 80% of the invoice amount. Again, interest will be repayable on that amount. The advance must be repaid over a day of 60 to 90 days usually, and is not dependent on the debt being collected. Invoice discounting is more important than factoring now because it's a confidential form of financing, i.e. your customers may not know. There's a lower fee than factoring, so typically 0.2% to 3% of sales, and companies do not have to give up control of the sales ledger to a factoring or financial institution. So it's definitely one of the benefits when compared to debt factoring in the previous slide. Now let's move on to medium-term sources of finance. Remember that medium-term sources of finance are repayable over a period of 1 to 5 years. There is a number of medium-term sources of finance we are going to look at throughout this module. This includes leasing, hire purchases, venture capital, crowdfunding, business angels, grants, and term loan. Let's now take a look at leasing. A lease is a contractual agreement whereby the owner of an asset, i.e. the lessor, allows another party to lease the asset, the economic use of the asset for a specific period of time in return for regular rental repayments. So for example, you might lease the asset for a period of 3 years, and over that 3 years you will make rental payments to the lessor. There's a wide range of assets leased, and it typically goes from heavy machinery to furniture. It may be costly, but payments are tax deductible. What we mean by tax deductible is that when computing the tax liability for the organisation, the repayments made in respective leases are tax deductible, and it reduces the overall tax bill of the organisation. So it's definitely a benefit that a lot of organisations avail of. The advantages of leasing is it allows financing when further borrowing is not available. So it could be a case that it's no longer viable or it's no longer possible to get a term loan. Less risk is so attached to leasing for the lessor as it's easier to repossess the lease asset. Leased assets may be upgraded, allowing flexibility where there are changes in technology, and it typically avoids a large cash outflow for the organisation. However, there are some disadvantages. By leasing rather than purchasing, there may be a loss of capital appreciation of the asset, and the effective interest rate can be high, so i.e. the interest rate charged on leasing tends to be higher than the interest rate that may be available on a term loan. As a result of that, it is an expensive source of finance for organisations. Next, we have the sale and lease back. This is both a medium or long-term source of finance. The business raises finance by selling an asset, for example, land or equipment, usually to a financial institution, so for example AIB Bank of Ireland, and agrees to lease it back over a specific period of time. Similar to our leases in the previous slide, the lease payments may be tax deductible, so i.e. reduce the tax bill of the organisation. It does, however, depend on the arrangement of the asset. It may belong to the financial institution at the end of the lease period. This will depend on the contract between the organisation and the other banking institution. Companies get cash now, but ends up paying it back over a longer period of time, so i.e. it's almost like a loan. There may be a loss of any capital appreciation if the asset is a building. Capital appreciation relates to the rise in the value of that particular building over a period of time. The next source of finance that we're going to look at is hire purchase, and this is where we purchase an asset by payment of instalments. There's typically 3 parties involved: the purchaser, the seller, and the financer. There's two types, and it can differ in relation to the ownership that is transferred. The hire purchase agreement is where the ownership remains with the seller until the last payment. The agreement covers the rental period with an option to buy at the end for a nominal fee. The credit sale agreement is where the ownership is transferred immediately and the purchaser agrees to pay for the asset over a specific period of time. A deposit is normally required and is normally for a period of 1 to 5 years. The hiree is responsible for the maintenance and insurance, so i.e. the individual that's actually hiring out the piece of asset. The use of the asset is without a huge outlay, so i.e. without actually investing in the asset up front. The asset may be repossessed if payments are not made, and it can be an expensive source of finance to the organisation. This now concludes Video 2 on sources of finance. Video 3 will commence with external sources of finance looking at venture capitalists, also known as private equity. Thank you for listening.